Every trader looks for signals in the market. Today, I'll share the most powerful candlestick and chart patterns that can help you predict reversals, breakouts, and trend directions. But remember, these are not just patterns. We'll turn them into a complete trading strategy. Patterns work best when combined with the overall trend. First, identify the trend using moving averages or trend lines. Then confirm with candlestick patterns. Reversal patterns strategy. Bullish engulfing. This chart highlights the bullish engulfing pattern, one of the strongest candlestick reversal signals. A bullish engulfing forms when a small red candle is immediately followed by a large green candle that completely covers the red body. This shows that buyers have stepped in with strong momentum. In this example, the bullish engulfing appears right at the trendline support, making the signal even more reliable. The entry point is triggered as soon as the engulfing candle closes. The strategy is simple. Enter at the close of the engulfing candle. Place your stop loss just below the trend line or the engulfing candle's low. Set your take profit at the top of the rising channel or the next pivot high. The bullish engulfing pattern works best when it aligns with trendline support, making it a powerful tool for spotting trend continuation setups. Let's jump into the next setup, bearish engulfing pattern. This chart shows the bearish engulfing pattern, one of the most reliable bearish reversal signals. The pattern forms when a small green candle is immediately followed by a large red candle that completely engulfs the previous body. This signals that sellers have taken control after buyers showed weakness. In this example, the bearish engulfing forms at a previous pivot high, which makes the reversal even stronger. Once the engulfing candle closes, traders can enter short positions. The strategy is simple. Enter at the close of the engulfing candle. Place your stop loss just above the engulfing candle's high or the resistance zone. Set your take profit at the next support level, such as a weekly or daily support zone. When combined with key levels like pivot highs or strong resistance, the bearish engulfing pattern becomes a powerful tool for catching trend reversals and market tops. Let's jump into the next setup, Morningstar pattern. The chart begins with a strong downtrend where sellers are clearly in control. As price approaches the support zone, we start looking for a potential reversal signal. At the support level, we see a three-candle formation. First, a large bearish red candle showing strong selling pressure. Second, a small candle, often a doji or a small-bodied candle, which signals indecision in the market. Finally, a strong bullish green candle that closes above the midpoint of the first candle. This three-candle sequence forms the Morningstar pattern, a powerful bullish reversal signal. Traders usually enter after the confirmation candle closes, setting their stop loss just below the support zone. As the market shifts momentum, the price begins a strong uptrend, providing a profitable long opportunity. Let's jump into the next setup. Here we have a clear example of the evening star pattern, a powerful bearish reversal signal. First, notice the strong uptrend leading into the pattern. The first large green candle shows strong buying pressure. Next, the second candle forms with a small body, showing indecision in the market. This tells us that buyers are losing strength. Then comes the third candle, a large red candle, confirming that sellers have taken control. This completes the evening star formation. Now, let's look at the trading setup. The stop loss is placed above the high of the third candle to protect against false signals. An alternative entry can be taken at the midpoint of the third candle for a safer confirmation. Finally, the take profit target is set at the previous support level, where price is likely to find buying interest again. The evening star helps traders spot potential trend reversals and secure profits by entering at the right time. Let's jump into the next setup. Here we see the hammer candlestick pattern, a strong bullish reversal signal. The hammer forms after a downtrend. Notice the long lower shadow. This shows that sellers pushed the price down, but buyers stepped in with strength and drove it back up, leaving a small body at the top. This tells us that selling pressure is weakening and buyers are taking control. Now let's apply the two-lot strategy to this setup. We enter the trade right after the hammer confirmation. A stop loss of 20 pips is placed below the hammer's low, protecting against false breakouts. For risk management, we split the trade into 2 lots. The first lot takes profit at 40 pips, securing quick gains. The second lot is allowed to run further, with the stop loss moved to break even once the first target is hit. This way, we eliminate risk while keeping the chance for bigger profits. Finally, the second lot also hits 40 pips, giving us double confirmation of the pattern's strength. This strategy combines the power of the hammer reversal signal with disciplined risk management to maximize returns safely. Let's jump into the next setup. Here we see the shooting star candlestick pattern, a powerful bearish reversal signal. The market is in a downtrend, but notice how small rallies form during the move. Each time, buyers attempt to push the price higher. The shooting star appears at the top of these rallies. It has a small body near the bottom and a long upper shadow. This shows that buyers tried to drive the market up, but sellers quickly regained control, pushing the price back down. This rejection of higher prices signals weakness and confirms the continuation of the downtrend. In this chart, we can see 2 shooting stars forming after rallies, each followed by strong bearish movement. This makes the shooting star a reliable tool for spotting entry points during a downtrend. Traders often place their entry just below the shooting star's low, with a stop loss above its high, and target the next support level to maximize profits. Let's jump into the next setup. Bullish piercing line pattern. In this chart, we can see a strong downtrend where sellers are in control and the price keeps moving lower. But then, notice this formation. It's called the bullish piercing line pattern. It occurs when a long red candle is immediately followed by a strong green candle. Importantly, the green candle opens below the previous red candle's close, but then pushes up and closes more than halfway into the red candle's body. This signals that buyers are stepping in with strength, overpowering the selling pressure. As we can see in the chart, after the piercing line pattern forms, the downtrend loses steam and a new uptrend begins. Traders view this as a powerful bullish reversal signal, often used to identify potential buying opportunities. Let's jump into the next setup. Here we see the 3 white soldiers pattern, a powerful bullish reversal signal. It forms after a clear downtrend when 3 strong green candles appear one after another. Each candle opens within the body of the previous one and closes near its high, showing steady and controlled buying pressure. This signals that buyers are stepping back into the market with confidence. The entry point comes after the 3rd soldier, with a stop loss placed just below the pattern. A logical take-profit target would be the next major resistance level. Notice how the RSI also confirms the momentum shift, giving even stronger evidence of a potential trend reversal. Traders see the 3 white soldiers as one of the most reliable candlestick signals for spotting bullish trend reversals. Let's jump into the next setup. This chart demonstrates the importance of a trend line in analyzing market direction. A trend line is simply a straight line drawn across significant price points. In an uptrend, we connect the higher lows. Price has been climbing steadily, and each time it pulls back, it finds support at the trend line. We can clearly see 4 major points: bottom 1, bottom 2, bottom 3, and bottom 4. Every time price touches this line, buyers step in, pushing the market higher. This repeated behavior tells us that the trend line is strong and that buyers are in control. As long as the price stays above the trend line, the overall movement remains bullish, meaning traders can look for entry opportunities whenever price comes back to touch the line. The trend line acts as a dynamic support level. In summary, trend lines are a simple but powerful trading tool. They help traders identify the direction of the market, highlight potential buying or selling zones, and give early warnings when a trend might be losing strength. Let's jump into the next setup. This chart shows the cup and handle pattern, one of the most reliable bullish continuation setups. The pattern forms in 3 phases. Spot the cup. Here, the market makes a rounded bottom, looking like a cup. This shows that selling pressure has eased and buyers are slowly regaining control. Find the handle. After the cup is formed, the price consolidates in a small pullback or sideways move. This creates the handle, where weaker traders exit and stronger buyers prepare for the next move. Breakout. Once the handle is complete, the price breaks out strongly to the upside. This signals the continuation of the prior uptrend, often leading to significant gains. Traders typically enter at the breakout point, place a stop loss just below the handle, and target previous resistance or higher based on the cup's depth. The cup and handle is a powerful strategy for identifying bullish momentum and capturing big moves in the market. Let's jump into the next setup. This chart illustrates the AMD pattern strategy, which stands for accumulation, manipulation, and distribution. Phase 1. Accumulation. Here, the market consolidates in a range. Institutions are quietly building positions, while retail traders see it as sideways movement. Phase 2. Manipulation. Next, the market makes a false move, often breaking out of the range to trap traders in the wrong direction. This manipulation phase creates liquidity for smart money to enter. Phase 3. Distribution. Finally, the market moves strongly in the opposite direction, which is the true trend. In this case, price drops sharply after manipulation, marking the distribution phase. Traders can use this pattern to avoid getting caught in false breakouts and instead align with institutional moves. The key is to identify accumulation zones, wait out manipulation, and then trade with momentum during distribution. Let's jump into the next setup. This chart shows the head and shoulders pattern, a classic bearish reversal setup. The pattern forms in 3 parts. First, the left shoulder appears as price makes a high, then pulls back. Next, the head forms as price pushes to a higher peak, but then falls again. Finally, the right shoulder forms with a lower high, showing that buying pressure is weakening. The key level here is the neckline. Once price breaks below this support, the pattern is confirmed, and a bearish move usually follows. Traders typically enter at the neckline breakout, place a stop loss above the right shoulder, and set their take profit based on the measured move from the head to the neckline. The head and shoulders pattern is a reliable signal that an uptrend is losing momentum and a potential downtrend may be starting.